Hello everyone and welcome back to our lecture series on process planning and cost estimation. In today's session, we are turning out our attention to depreciation. We will look at what causes assets to lose value over time, examine the primary industrial mathematical model used to account for this loss, and walk through several detailed numerical examples to see how these methods apply to factory machineries. Let's begin. Let's first establish a formal definition for depreciation. Depreciation refers to the continuous reduction in the overall monetary value and operating efficiency of the plant, piece of a machinery, or any fixed asset. This decline happens naturally due to physical wear and tear, the passage of time, routine operational usage, and changing climatic environmental conditions. From an accounting perspective, depreciation is a systematic method utilized to spread the initial capital cost of a fixed asset over its expected useful life or years of service. Rather than taking a massive financial hit the year a machine is bought, we allocate the total cost across the entire timeline. It generates revenue for the firm. There are these are the various reasons for the depreciation. You can see this flow chart indicates the various reasons for depreciation. So they are broadly categorized into two: depreciation due to physical condition, depreciation due to functional condition. The depreciation due to physical conditions is classified into wear and tear, physical decay, accident, and poor maintenance and neglection. And depreciation due to functional conditions are inadequacy and obsolescence. So coming to the methods of depreciation, there are several methods used by the manufacturing firms to calculate and build up the depreciation funds. Choosing a method depends heavily on the type of assets, a company policy, and tax regulation. So as listed on the slide, the primary methods include the straight line method, the diminishing or reducing balance method, the sinking fund method, and the annuity method. So other approaches include the sum of years digits method, the insurance policy method, and operational metrics like the machine hour and production unit methods. So today we will examine the calculations behind the most prominent of these models. So we'll start with the most straightforward approach, the straight line method. So under this model, the total depreciation value is distributed equally across the useful working life of the machine in identical periodic installments. To calculate the annual depreciation amount, we use the formula D is equal to C minus S divided by N rupees. Here C is the initial cost of the machine in rupees, and S is the scrap or salvage value in rupees, and N is the estimated life of the machine in years, and D is the depreciation amount per year. So this method is a very simple method to implement. Its primary drawback is that it fails to account for changing maintenance and repair charges, which typically rise as a machine grows older. So let's look on a practical straight line problem. A CNC machine was purchased for rupees 1,25,000 on 15th June 2025. 2005, and the erection and installation cost was rupees 10,000. The CNC machine is to be replaced by a new one on 14th June 2020. If the estimated scrap value is rupees 25,000, what should be the rate of depreciation and depreciation fund on June 14th, 2012? If after 9 years of running some machine parts are replaced and the estimated replacement cost is 4,000, what will be the new rate of depreciation? So there are two questions from the two sections of the problem. We will try to solve this. So we have two objectives. First, to calculate the rate of depreciation and depreciation fund on June 14, 2012. Second, if some machine parts are replaced after 9 years of running at a cost, calculate what the new modified annual rate of depreciation will become. Okay, right, let's break down the solution. First, we find the total initial cost by adding the baseline purchase price to the installation expenses, giving us the total intended life of the machine from 2005 to 2020 is exactly this one. Okay, the depreciation rate is total cost, machine cost is 1,25,000 plus rupees 10,000 as a scrap value to 1,35,000. So life of CNC machine as of 15th June to 14th June 2020 is 15 years. The scrap value is 25,000. So the depreciation D is equal to, by applying this in the formula, we know the value of C, S and N. By applying this directly, we can get depreciation D is equal to 7,333.33. So to find the accumulated depreciation fund by June 14th June 2012, we count the elapsed time, which is exactly this much. Okay, so 7 years. Therefore, the rate of depreciation will be 7333.33 into 7. So that is rupees 51,333.33. So now coming to the second part of this problem, replacement cost. Now let's take accounting for the replacement parts at the 9-year marks. After 9th year, the book value or current value of the machine will be initial cost minus depreciation cost of 9 years, which is 1,35,000 minus 7,333.33 into 9, that gives 69.00.3. Adding this value with the replacement cost, we will get 73,000.03, that is the new value of the machine C dash. So by using this new value of the machine, if we calculate the depreciation, then it accounts to 8,000 rupees. Next is a diminishing balancing method. So next, the diminishing balancing method is also known as a reducing balance method. Unlike the straight line approach, this model applies a fixed percentage to the remaining book value of the asset each year, meaning depreciation is highest in year 1 and decrease over time. So this can be calculated by using this formula. Depreciation factor P is equal to 1 minus S divided by C power 1 by N, where C is the initial cost of the machine in rupees, S is the scrap value or salvage values in rupees, and N is the estimated life of the machine in years. So coming to the examples for a diminishing balance method, the problem is a certain machine was purchased for rupees 25,000, and it was presumed that it will last for 20 years. It was also considered that by selling a scrap value of the machine, the residual value will be rupees 4,000. If the depreciation is charged by reducing balance method, find out the depreciation fund after and depreciation amount for the third year. Also find out the percentage by which the value of the machine is reduced by every year. So in this case, the data given is C is equal to 25,000 and S is rupees 4,000. So percentage by which the value of the machine is reduced every year by using the formula which is given in the previous slide, P is equal to 1 minus S divided by C power 1 by N, that's equal to 0.08755. Okay, then value of the machine after first 1 year, that is C into 1 minus P, we get rupees 22,811. Then depreciation fund after the first year, from total 25,000 we have to subtract this value, we will get 2,188.91. Similarly for the second year, 22,811 into 1 minus 0.08775, we will get this value. Then similarly we have to calculate the depreciation fund of the second year. Okay, so likewise we have to calculate for the third year, because it is given, it is asked to calculate the depreciation amount at the end of the third year. Okay, so the depreciation fund after third year will be 1,823.16. so depreciation fund after third year will be adding all those depreciation values, 2188.91 plus 1997.11 and 1823.16, will get rupees 6,009.18. Okay, next comes the sinking fund method. This model assumes that the annual depreciation funds are not just sitting idle. Instead, they are invested in an interest bearing fund to grow over time. So the depreciation can be calculated by using a sinking fund depreciation method like D is equal to C minus S into R divided by 1 plus R power N minus 1, where C is the initial cost of the machine and S is the scrap or salvage value in rupees, and N is the estimated life of the machine in years, and R is the rate of interest on depreciated fund in percentage. Okay, so this is the direct substitution. We'll go with a small numerical problem with the sinking fund method. A power hacksaw machine was purchased for rupees 25,000, which is the initial cost of the machine. After 5 years, the machine was valued at rupees 10,000. Finding out the depreciation amount according to the sinking fund method, the rate of interest being 5%. So all the values are directly given here. The initial value of the machine is 25,000 initial cost, and N is equal to 5 years, and S is 10,000, and R is 5%. So what is the depreciation fund? Directly substituting all these values, we will get rupees 2,714.62. Okay, next comes the annuity method. Annuity method takes the opposite perspective of the sinking fund model. It views the capital spent on purchasing a machine as an internal investment that should have been earning interest for the business. So therefore, it charges interest on the diminishing capital value of the asset over time. So accordingly, the annuity method, depreciation of the annuity method can be calculated by using this formula: D is equal to C into 1 plus R power N minus S into 1 minus 1 plus R divided by 1 minus 1 plus R power N, where C is the initial cost, S is the scrap, and N is the estimated life of machine, and R is the rate of interest on depreciated fund in percentage. So we'll go with a small example. Let's calculate the depreciation annuity for a machine with an initial cost of a planned life cycle. After 4 years, when the cost of the machine is 15,000, scrap value is 3,000. Take rate of interest as 5%. So we know the value of C, we know the value of N, we know the value of R, and we know the value of S. So all the values are available, and we can directly substitute all the values in this formula. We'll get rupees 3534.14 as the depreciation values. Okay, next method is the machine hour method of depreciation. So this method assumes that a machine's wear and tear is directly tied to how many hours it actually runs rather than how many calendar years that have been passed. So under this approach, we first establish a fixed depreciation rate per operating hour using the formula: depreciation rate per hour is equal to C minus S divided by total machine hours over useful life of the machine. So this method is highly effective for calculating cost accurately when a factory production volume fluctuates significantly from year to year. So an example problem for machine hour method. So let's apply this to a shaper machine with an initial cost of 85,000, scrap value of 8 years is 8,500. So the machine works for 3,330 hours in a year. Calculate the rate of depreciation charge per hour by the machine hour basis method. Also calculate the rate of depreciation charge annually. First we calculate the total lifetime hours, that is 8 years into 12 hours per day into 365 days per year. We will get 35,040 hours. Next we will find the hourly rate. Depreciation rate per hour is C minus S divided by total machine hour over useful life of the machine. Okay, by substituting these values, we will get rupees 2.183 per hour. Then we will calculate the rate of depreciation which is charged annually, that is equal to depreciation rate per hour into number of hours in a year. That by substituting all the values, you will get rupees 9561.54 per year. Next comes the production unit method of depreciation. So this method is similar to the machine hour approach. This method measures a machine's life by its total expected physical output rather than time. So here we calculate a fixed depreciation cost per individual unit produced using the formula: depreciation cost per unit is equal to C minus S divided by number of units it is expected to produce. This approach is ideal for specialized manufacturing machinery that is dedicated to a single high volume product line throughout its entire life. So let's look our final problem. Calculate the depreciation rate per unit of a machine whose initial cost is 2,25,000 and the estimated residual cost after a useful life of rupees life of the 10 years is rupees 20,000. It is estimated that the machine will work 50 weeks a year of 46 hours a week. The rate of production is estimated to be 10 units per hour. Okay, first we calculate the total lifetime units the machine is expected to produce over its 10-year lifespan. So number of units of the machine is expected to produce is the life of the machine in years into number of working hours into production units per hour. 10 into 50 into 46 into 10, that is 2,30,000 units. Then we plug into our formula to find out the unit depreciation cost. This brings this gives a value of rupees 0.89. So with this we end this lecture. Thank you very much for your useful time, and I look forward to seeing you all in our next session. Thank you so much.